Welcome to London Property News Bulletin. Every week, we break down the key headlines and the wider news that could influence the market, keeping you informed and confident in your decisions. Here is what you need to know this week.
If you own property in London, here's a question worth sitting with. Could paying off your mortgage actually be costing your family money? It sounds counterintuitive, but financial planners are increasingly warning that for London homeowners, the race to become mortgage-free may be quietly inflating their inheritance tax bills. Here's why. Inheritance tax is charged at 40% on estates above £325,000. That threshold hasn't changed since 2009. For couples, combined allowances can stretch to £1 million, but in London that figure can be eaten up by the property alone, before savings or investments are even counted. So, families who've done everything right, worked hard, paid off the mortgage, built up a nest egg, are finding that HMRC has effectively become an unwelcome beneficiary when they die. Now, here's the part that surprises most people. If you die with a mortgage still outstanding, that debt is deducted from your property's value before inheritance tax is calculated. A £1.2 million home with a £300,000 mortgage doesn't add £1.2 million to your estate. It adds just £900,000. That's a meaningful difference, and on a 40% tax rate, it could save your family tens of thousands of pounds. Some homeowners are now deliberately keeping mortgages in place, using interest-only deals or longer fixed-rate terms, and redirecting the capital they'd have used to pay it off into pensions, ISAs, or gifts to family. And that last point matters. The real tax planning isn't in the mortgage itself, it's in what you do with the money you're not using to pay it down. Gifts made regularly from surplus income can fall outside your estate straight away. Larger gifts fall outside entirely after 7 years. Both strategies tend to be more effective than relying on the mortgage debt alone. There's also a pension warning worth flagging. From April 2027, unspent pension pots will be pulled into inheritance tax calculations for the first time. For anyone with significant pension wealth, the clock is ticking on some important decisions. That said, this approach isn't right for everyone. If your mortgage rate is high, the maths may not work in your favour. And it requires real financial discipline. Money that doesn't go towards the mortgage needs to be actually invested or gifted, not absorbed into everyday spending. There's also something to be said for the peace of mind that comes with owning your home outright. That's a personal calculation no spreadsheet can make for you. The bottom line, if you own London property and you're thinking about your legacy, the old rule, clear the mortgage as fast as you can, is worth revisiting. A conversation with an independent financial advisor is the best place to start. Now, a story that could be significant for London's first-time buyers. A new report, backed by more than 50 housing sector bodies, including major house builders Vistry and Barratt Redrow, is urging the government to let graduates swap up to 20% of their student debt for a government equity stake in their first home. The idea is straightforward. Graduates get a discount on the purchase price. The government gets a share of the proceeds when the property is eventually sold. Everyone, in theory, wins. The report was produced by a commission chaired by Labour MP Chris Curtis, and it's being presented to government figures this week. The timing matters. More than half of London renters, 56%, have already given up on ever owning a home. And the number of Londoners aged 25 to 45 who feel they may have to leave the capital altogether has nearly doubled since 2023, from 22% to 42%. The Commission is also calling for a new equity loan scheme to replace Help to Buy, which was scrapped in 2023, this time part funded by developers themselves rather than entirely by the taxpayer. The government says their house building target remains 1.5 million new homes, but official forecasters say completions are actually set to fall in the year ahead. The new tax year kicks in next week, and for London property owners and landlords, there are some changes worth paying close attention to. First, landlords. If you're a sole trader or a landlord earning above £50,000, making tax digital comes into force in April. That means quarterly digital tax returns starting now. The threshold drops further to £30,000 in 2027, so more landlords will be pulled in over time. For those with significant property portfolios, the tightening of business property relief and agricultural property relief means assets above £2.5 million will now attract an effective inheritance tax rate of 20%. Estate planning just became more urgent for high-value property holders. On the subject of inheritance tax, AIM shares, often used by wealthier Londoners to offset inheritance tax liabilities, are losing half their relief. That 100% exemption drops to 50%, leaving a permanent 20% inheritance tax exposure. And the working from home allowance, worth up to £312 a year, is gone entirely from April, a small but real cost for anyone running a property business from home. The broader picture between these changes, the upcoming pension tax reforms in 2027 and frozen nil-rate bans, the tax burden on London property wealth is quietly but steadily increasing. If you haven't reviewed your position recently, now's the time. A significant moment for London's rental market is now just weeks away. Sadiq Khan has launched a £400,000 enforcement fund to help renters take rogue landlords to court, aimed to coincide with the Renters' Rights Act coming into force on the 1st of May. The act is being described as the biggest shake-up of the private rental sector in 40 years. Key changes include the abolition of no-fault Section 21 evictions, an attempt to ban competitive bidding, and new protections for tenants with children or those on housing benefit. The fund will be distributed to renters' unions and councils, where the claim is that it will be used to train enforcement officers and support tenants in understanding and exercising their new rights. And that last point is critical because awareness is remarkably low. Research suggests that nearly 2/3 of London renters are either unaware of the Act or don't understand how it affects them. With 2.7 million private renters in the capital, that's a significant gap between legislation and reality. Khan is also renewing his push for rent control powers, a position backed by Greater Manchester Mayor Andy Burnham. A recent poll found 3/4 of Londoners support a cap on annual rent increases. The government, however, has made clear that rent control remains off the table for now. For landlords, May the 1st is a date that cannot be ignored. For renters, it may be one worth knowing about too. A stark picture of London's housing challenges has emerged this week, and the numbers are difficult to ignore. Just 5,547 new homes were started in London last year. Despite the lofty pronouncements of Mayor Sadiq Khan and the Labour government, that's a drop of more than 75% from a decade ago, and the lowest figure in at least 15 years. The reasons are well documented but compounding. Construction costs have risen steadily for 6 years, driven by post-pandemic supply chain shocks, the war in Ukraine and a reduced labour pool following Brexit. Higher interest rates have made development financing more expensive, and a regulatory backlog, partly a legacy of the Grenfell Tower tragedy but also due to Mayor Khan's increased regulations, means building plans can be stuck in approval queues for years. The result? Thousands of projects cancelled or stalled, more than 5,000 homes across London currently sitting unfinished. Construction firms now account for 17% of all insolvencies in England and Wales. When John Lewis, a company with deep pockets and strong brand recognition, quietly shut down its build-to-rent operation this year, citing unworkable economics, it sent a message that went well beyond one corporate decision. For buyers, the human cost is clear. The average London apartment now costs £430,000. On a median salary, a couple would need more than 12 years just to save a deposit. Sadiq Khan and Housing Secretary Steve Reed wrote to house builders this week calling for stalled schemes to be unlocked, with planning concessions and tax breaks on the table. In other words, they're trying to reverse some of the problems they've created in the first place. There are cautious signs of optimism, but London's housing crisis, as one expert put it, won't be solved by numbers alone. What's needed is genuinely affordable homes, and right now the economics of building them simply don't stack up.
That wraps this week's London Property News Bulletin. Thank you for listening. If something caught your attention or you need support navigating the impact of the news, then please reach out to us. We're here to guide you. If this was useful, do pass it on to someone who also follows the market, and don't forget to subscribe to stay one step ahead.